Welcome to Real Estate Radio Live, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Joe Cucchiara.
Live in the entire Bay Area. You can listen to us a couple different ways. One is on your radio at 𝗘𝗀𝗎𝗪 1220 AM. You could also listen to us live anywhere online. If you go to 𝗘𝗀𝗎𝗪.biz, what we'd love you to do is download one of the podcasts. You can listen to us, take that anywhere. A couple different ways. You go to iTunes, any of the regular places to download the app, but you could also go to our website at 𝗪radiolive.com. That's 𝗪radiolive.com. Download the podcast. That way you could follow the show anywhere you go, no matter where. We're a live show. We love your interaction, calls, questions. A couple different ways you could reach us while we're doing the live show. One is toll-free number, 1-800-516-1220, or you could also text 408-838-9060. Most of you know the show, since I've started for 4.5 years, have been focused on education and information. What we try really hard to do is have great guests like I have today. I'll introduce in just a minute. Content, information to help you, the consumer, make wise decisions in and around your real estate. And real estate is an important topic in this area for sure. So that's what we try to do on a regular basis. We'll continue to do that. And this time, let me invite my guest in. Today, we're joined by Shawn Okumura. He is a CFP, Financial Advisor and Principal for Transitions Wealth Advisors. And we also have with us today Jeff Trevarthen. He's a loan officer here at Bay Equity along with me. So welcome in, guys.
Thank you.
Thanks a lot, Joe.
Good to have you. Good to have you guys here. So today's topic, and we were laughing a little bit off air, is going to be the how to weather a volatile stock market. So hold on, buckle your seatbelts. We have the expert in studio here for the entire market. Don't mean to put you on the spot here, Shawn, but that's okay. You're probably used to that, right?
I am.
He's used to that.
Yeah.
So if you have any questions, we're going to have this topic. We're going to have just a great conversation today about how to weather the volatile stock market. And Shawn's here. He's going to talk about the ins and outs and some investment strategies and some other things. So if you have any questions, again, you could text 408-838-9060 is the best way to text during the show. Why don't we get started, Shawn? Tell us a little bit about your background and then kind of your roles and responsibilities of who you're with today and what you're doing.
Sure. Well, thank you again for having me.
You're welcome.
I run a wealth management practice, a boutique. We're an independent practice with our office in Willow Glen. I've been in practice now about 19 years. Okay. This is my 19th year in business, and we focus mainly on families and individual small businesses that we help with their overall wealth management.
Very good. So, Jeff, you have been working with Shawn how long now?
Probably over a year or so.
A year or so?
Yeah. We met when our kids were playing baseball together.
And so you would recommend Shawn, it sounds like. I mean, we've got him on the show. You've said a lot of really good things about his practice, his business. So I wanted to have you on the show. It's a good idea for the three of us, too. Just in the perspective of working with Shawn. You've got the experience. You have some clients that did along the same, and I assume that you've worked with Jeff in the mortgage area as well?
Yep, actually very recently, yes.
Good.
Yeah. Timing is fortuitous.
It is for sure. It is for sure. So maybe before we get into the middle of this, maybe give us kind of an overview. I don't mean to put you on the spot, but I will. Before we get into our talking points, the market's been just crazy. The volatile, the topic today is appropriate, of course. So maybe if you could give us your observation, Shawn, why is the market going through this? Some ideas or suggestions, and then for those people that are just really kind of reeling right now and not sure what to do and how to kind of take the next step, or a lot of people are nervous about it when the market has the ups and downs like this. So why would, I guess the first thing is, why is the market? Is there any rationality to this, or is there no rationality at all?
I think rational is a relative term in our business,
yeah.
and you hit it on the head. There's a lot of nervous people right now. I would say sentiment is driving more of what is happening rather than necessarily underlying economic fundamentals. You've got concerns about slowing growth in China, and one of the things I would emphasize is that the word growth is still a part of that. It's not no growth. It's that China has slowed from double-digit GDP to maybe the mid to high single GDP, which is still 2 times what the U.S. does over the last few years. So rightfully so, there's concerns there. Concerns obviously about $28 a barrel oil, which we'd been trading in the $40 range, and what's going to happen to the energy companies and the debt that those energy companies hold, and then the banks that are lending that money to those energy companies. So you've got a number of factors. You've got concerns in Europe. So if you look at the global impact of what's going on, that's driving a lot of the sentiment right now.
Yeah. So is it like the oil, is that a little speculative? And what I mean by that is that people getting nervous that, oh my gosh, everybody's going to be driving electric cars, we're not going to need oil anymore. I mean, all this, right? Is it more so these nervous concerns of people just making trigger judgments and decisions sometimes? What?
Well, from the company standpoint, you do have to have concerns with the price of oil being where it is. I mean, there is an oversupply, and with the oversupply, that's allowing the prices to be where it is. You got to remember, on the flip side of that, right, the consumer's loving it, right? I mean, what did I see? An article in the paper the other day about gas prices being the lowest it's been in the last, I don't even know. I mean, $2 a gallon in some places within the Bay Area. I mean, when was the last time that happened, right? So
that's a good point.
There's some negatives, but it comes along with some positives as well.
Yeah. Overall, is it? And I don't want to put words in your mouth, but what advice would you give a person that's in the market? I know it depends how old they are. There's a lot of factors that goes into that, but is it still a long-term view and look and just make sure you're diversified and make sure you have a plan with your advisor? Maybe.
Absolutely. Okay. I mean, that does not change. Okay. This is my 19th year. I've seen two really bad bear markets from 01 to 03 as well as the 08, 09 downturn. And when you can stay focused on your long-term goals and that time horizon as far as your investments go, I've seen each client that was able to do that come out of that well. It's those that make those knee-jerk reactions that end up typically losing more than had they stayed the course. But sometimes it's a tough sell, right? When you see your portfolio down 10, 15% within a 5 or 6 week window, it's understandably gut check time. Yeah,
understood. If you're just tuning in, this is Joe Cucchiara with Real Estate Radio Live. We're with you 5 days a week, and we have in studio Shawn Okumura, right?
Okumura, yes.
Okumura. Yeah. And Jeff's along with us, too. We're talking about the stock market, and really the topic is how to weather a volatile stock market. But we're going to get more detailed into some strategies as well. If you have any questions for Shawn, a couple different ways you could reach us. Live phone number, 1-800-516-1220, or you could text your questions or comments in at 408-838-9060. Let's get to the more important stuff. Now that you gave us an overview of the market, talk a little bit about the Roth IRA, because I think it's a great vehicle, but if you give us kind of an overview of it, and then I think the perception too was if you made a certain amount of money, it really didn't make sense in the past. So maybe you could give the listeners kind of an overview about the Roth, the benefits of the Roth, and who could benefit from it, actually.
First and foremost, the Roth IRA, for those that can contribute and are eligible to participate, it gives a tax-free way to access your retirement funds. Okay. And in this day and age, what can we say is tax-free at some point in terms of taking money in retirement? So that is the long-term benefit. The point I'm making right now is not about contributing to a Roth, which is limited by your income. And a lot of us that live in the Bay Area, we are very fortunate that our incomes exceed the qualifying dollar amount, the AGI limit. But what I'm talking about is a conversion. Those of you who have worked at companies, have old 401ks, and you now have an opportunity to convert that to a Roth. Granted, you have to pay the taxes on it. But that is why potentially now is a good time to do it. Let's call it $100,000 401k. Okay. Fortunately, unfortunately, it's probably worth maybe $85,000-$90,000 right now. Yeah. But you convert that over, you're going to pay taxes on a lesser amount than you would 5 weeks ago. Good point. And now you've converted and put that money in a place where it's tax-free for you in retirement.
And would that be any income level, or is this the people that meet that qualification?
No, so for the conversion, it's not. There's no longer. When it first came out, there was an income qualifier. You had to, I think, be under $100,000, right. some amount that was very limiting. They removed that, so now anyone can convert. You just have to pay the taxes in the year of conversion.
Got it. Okay.
So it's a good time to sit with your advisor, talk to your CPA. It's tax time. Your tax advisor, have a conversation about it. And if it makes sense, this is a great time to take advantage of it, to take advantage of a down market.
Okay. So the conversion part of it, then what about going forward to the contribution part of the Roth then? How different is that, or is that the same?
The contribution is still based upon the AGI limit,
okay.
Whether you're a single filer or married filing jointly, or depending on how you're filing. So there are limitations about contributing to what they call contributory Roth, that again, if you're with over a certain amount of AGI, you're not going to be able to do.
Got it. All right. Very good. What about let's talk a little bit about, you hear a lot of the diversification, but I guess that's true. But maybe you could take us through when you sit down with a client for the first time or someone's working with you. That's what I really like to hear, and I like our listeners to hear too. Maybe you could tell us how that looks, what the first consultation looks like, and then the recommendations. I'm guessing it's based on all different types of things. What is the process in which you take a client when you meet with them?
Sure, that's a great question. Each advisor will handle that situation differently.
Okay.
We always lead with planning. So before we implement any investment strategy, we need to understand what are the goals, what are the risks for the client, and address those first. Have a plan in place. When we get to the investment part of the strategy, then we're looking at how much do we have in equities? How much do we have, let's say, for example, international versus domestic? How much to have in small caps versus large caps? How much to have in fixed income, cash? When is the appropriate use of alternative investments? So we evaluate all of that, and it's a give and take. We're sharing the pros and cons of each investment strategy, getting their feedback, and then after getting that, then we implement.
Got it. So at different levels, do you guys actually put them through? Is there you give them some homework to do, put them through?
Absolutely, yeah. There's a lot of time and resources spent on both sides. The clients got their homework, and if they don't turn it in, and then we can't do our job, right?
Failing grade. Yeah. And then before we're going to take a break here in just less than a minute, you guys. So and then after that, once they get started, Shawn, do you set up regular meetings like it's once or twice a year? What's typical for your clients?
Yeah, absolutely. We like to say it's like going in for your dentist appointment. At least every 6 months we're sitting down face to face. But ideally we're having check-in calls quarterly, every couple months, and big life events. We want to be proactive in their lives. Very
good. All right, we're going to take our first break. When we come back, much more. If you have any questions about how to weather the volatile stock market or anything else, financially rated, having a conversation with Shawn, who is a CFP financial advisor and principal of Transitions Wealth Advisors. Kind enough to spend an hour with us here in the studio. And also joined by Jeff, who is a loan officer in our office here with Bay Equity Home Loans. Having a conversation about how to weather the volatile stock market, but the ins and outs and some of the benefits. And so that was the first part of the segment. And then we talked a little bit about, Shawn gave us some advice on Roth conversions. Before we move along, so would you recommend in general, if someone could do that, is that one of the best things a person could do, if it makes sense for them?
I think that's a conversation you definitely need to have with your tax advisor.
Everybody's different, right?
Everyone's different. And it's where you think your tax bracket's going to be in retirement versus today.
Good point.
So, I'm not making a blanket statement like, hey, everyone go out there and convert your Roth, because...
Shawn just passed the test of radio questions. He just passed it right there perfectly. All right, Jeff, we're going to talk a little bit about, I know you wanted to talk to Shawn a little bit about, planning and how important it is, but how that relates to really the mortgage and real estate area as well.
Yeah, so we were just talking here into the break a few minutes ago about the planning process, and I know that, Joe, you and I both probably share the same philosophy in the sense that we want to make sure we have good plans. And so, Shawn, what we wanted to ask you was, what is it that you do when you're doing that initial planning process? Do you look at just the assets, or are you looking at the liabilities that they have also and figuring out ways that they can maybe consolidate debt through a refinance for their mortgage, or ways to create more assets in that sense by getting a couple extra dollars for reinvestment somehow?
No, we absolutely. So before we start working with the clients, I shared, we go through that planning process. We're gathering up everything, their assets, their liabilities. We're looking at their Social Security statements, their pay stubs, their tax returns, their living trusts, as much information as we can. And, of course, our job is to grow the bottom line net worth of our clients. At the same time, it's also to understand the client's liabilities, and if there are ways for us to improve that bottom line on behalf of the client, absolutely. And I would say, part of right now So, what can you do in this volatile stock market? And one thing I would really emphasize is what has always gotten me and my clients through times like these is you got to focus on what you can control,
exactly.
right? And if there was one thing I could maybe say I could pound the table on today, it's like where we're, while it's not good for the stock market, rates for the bond market have gone into great territory, and it's a great time to look at the financing that you have for everything, whether it be your student loan debt, your personal loan debt, but most importantly, which is probably your largest asset, is your house.
Yeah, I agree. It's such a perfect time to go ahead and look into that stuff, especially with the way that the market has been over the last couple months here, for sure.
Yeah, and I think also what most people, we've been talking a lot on the show about it, and everybody should know by now, Shawn and Jeff, but seriously, the equity growth. Several years ago, let's face it, in 07, 8, 9, even 10, there was a lot of people that were either underwater or didn't quite have enough to take advantage, if you remember that last refinance market.
Absolutely.
Well, now I would think if you're in the Bay Area and actually outside of the Bay Area in many places, you should have had enough equity growth to really take advantage of that right now. So I would say that would be the last thing is, really take a look and figure out what that advantage is, because that could be another big benefit. Where a lot of people, even consolidating a first and second, those are a big thing right now. I don't think a lot of people understand those equity line seconds. Typically are fixed for 10 years, amortized for 30, but then they recast after the 10 year, which should be a big number depending on what kind of balance you have on there.
Well, with equity lines of credit, I think people are finally starting to see a bump in the rate, right? With the Fed rate increase. Exactly. I saw it on my line of credit, right, on my January statement. Oh, it actually went up a little bit, and so it is a good time to evaluate that. It's
funny, before we take our next break, and I'm listening to you, and so I was watching some of the hearings with, the Fed, right? Mm-hmm. And so for the last several years, everybody's talking about, when's she going to raise, when's she going to raise, when's she going to raise? So they finally raised, and now they're talking about, well, is there a possibility you could lower the rate again and get the
right? Yeah,
it's kind of comical. Yeah. Before we take it up, what did you thought about that whole thing? Is it just?
I would say 2 years ago there was a huge emphasis. Beginning of 2014, we thought, okay, rates by the end of the year were going to be higher. Okay, nothing happened. Same story in 2015. Right. My belief, it's a lower for longer rate environment. But I think if you look at the power that the Fed has to influence, whether it's sentiment or reality, it has a big impact.
Yeah, so it really does. All right, we're going to take another break. We come back. More the last segment, right before we took a break, we were trying to change the world and get the educational system to educate our kids about more financing. It drives me crazy. We're talking about it more. Shawn, that leads us to, I guess, the next question I want to talk to you about. I mean, the obvious thing is the earlier the better, right?
Absolutely.
We've done those exercises before when you took at the compounding factors of a penny versus $1 million and all that stuff, but doesn't it really come down to the sooner you start, and no matter what it is, whether it's 5%, 10%, or what is your philosophy? If you were, let's say if you're sitting down with a group of children or a group of someone that are in their 20s that just really start, what would your advice be to them?
My advice would be always from your first job. I remember when I first started in this business, I was in my early 20s. I couldn't save enough to be where I am today, but you start somewhere, and then you always build on it. Okay. And so I would say you get that first job, plan on putting in at least the minimum amount to get that company match, and then you grow it from there. Right. And no matter what, you always build on that. And there will become times in your life when you have life events that will maybe not allow you to put in as much, but you've already got that other money working for you. So you got to start young. You start early, and what do they say? The eighth wonder of the world is the power of compounding. So
so true. What is your opinion on the? It's come under heat over the last several years, like a lot of things, but the whole 401k. A lot of companies don't match. But they offer it, and it's encouraged because it's a tax benefit, right? It comes off your income.
Absolutely.
What is the difference if someone said, is that really the only benefit? Because then there's the other side saying, well, you got to be careful with some of these 401k plans. Who's managing the cost, the fees, or is it really, who's overseeing this thing? When you meet with a client, I'm assuming a lot of them have 401ks.
Yep.
Do you evaluate those programs for them and kind of give them advice one way or another, or give us your thoughts on that?
Yeah, absolutely. Again, part of our planning process is knowing where all the assets are, and those assets we cannot directly manage are those retirement plans tied in with the employer. Often it's 401k with teachers, 403b, government workers, 457. But you look at what investment options the client has, and you definitely want to make recommendations because you want to have a coordinated investment strategy throughout the entire client portfolio, not just what we can manage or not just in the 401k. Right. So, yeah, absolutely. And I would say with the amount of scrutiny that the 401k plans have come under in the last several years, there's a good chance that you have a decent plan.
That's good.
And those forms are readily available. I think it's called the form. This is not my area of expertise, Form 5500. You can pull that on your employer and find out what they're paying in fees on your plan.
Yeah. What the other thing in this area, what we see a lot, Shawn, and I'm not sure what the answer is, but Jeff, you could probably speak to this too. We see quite a bit. You get a person that's in their 60s, 70s, and maybe 80s. They've owned their home for 35, 40 years. In some cases, maybe the home's free and clear, which everybody used to strive for in the earlier generations. And so they have $1.5 million, maybe $2 million home free and clear, but they didn't do a very good job with the retirement. Maybe they didn't get a pension, or maybe their pension's $1,500 a month, and we know what Social Security's like.
Right.
Do you see that a lot sometimes? I mean, Jeff, you've worked with some people, and you don't know quite. So right away, you think reverse mortgage. You think what other options? What kind of recommendations would you have for someone? I mean, they're obviously later in life. We call them, house rich, cash poor, right?
That's right.
What would be some of your recommendations for people that are in that position?
We see that more and more, especially in the last 3 or 4 years, right?
Yeah.
We didn't see it so much between
Good point.
07 and 09 or 10, right? But with the amount of increase we've seen in real estate, it is more and more common. I think that the way we approach that is that there is a solution for every problem, and it's understanding what tools you have available. And there's pros and cons to each tool. And I know sometimes when the word reverse mortgage gets mentioned, it has a lot of negative connotations. I'm not sitting here recommending on a wholesale way a reverse mortgage, but I have seen where a reverse mortgage can be used in order to give a client a better lifestyle without forcing them to sell their home, without forcing them to potentially liquidate investments that the timing may not be right, or if they're all in a 401k, it's a taxable event. So it's looking at what's available to the client. We're looking at a client right now where she's in a situation, has a $1.8 million house, owned free and clear, but majority of her income is Social Security and a small investment portfolio. Possibly she could move out, rent it out, and take the rent differential. She could get $5,000 a month for the rent, right? Pay maybe $2,500 for a smaller place, and she can net maybe $2K a month for her to live a little nicer lifestyle. Right. So it's kind of looking at each client situation and sharing it. Okay, here's the pros and cons. Here's the tax consequences. Here's the estate consequences, and you get that feedback from the client.
Very good. What would you? We have a couple minutes left in this segment. Someone's listening out there today, and they're either maybe not quite sure if they're with the right advisor, or they really need to realize they need to find one now because maybe they're trying to manage their money by themselves. They realize it's not the right thing to do. What would the steps you would recommend someone that's looking for a financial planner advisor like yourself for them to do when they interview, talk, really figure out philosophy? What are some of the questions they should be asking when they interview someone to work with?
Absolutely. I think the first question they should be asking themselves is, am I a control freak? Right? I mean, let's be honest. You're going to turn over your life financials to someone, and you're trusting them. Yeah. And if you're not wired that way, it's going to be a difficult process, and it's probably not going to make for a very good relationship. So I think you start there. And if you are interviewing, truly go about interviewing. Oftentimes we'll get people saying, well, I'm interviewing, and we'll sit down with someone because they've come in on a referral, and they say, well, I'd like to interview some others. I'm like, great. I love that, because that means that you're taking the time to really look at what's out there and see what's a good fit for you. So if you're going to do that, make sure you're doing it. Go talk to 2 or 3 at least and see what's a good match for your personality. There's so many types of different advisors out there, and I'm not going to say one is better than the other. It's all about what you need.
Yeah, good point. All right, we're going to take our last break. When we come back, we're going to finish up. Again, if you have any questions, the financial expert is in studio. 408-838-9060, or you could call the live line, 800. Wind down the show here. Just a couple more minutes left. If you want to text numbers, or I should say questions in, 408-838-9060. Just finishing up with Shawn, who is the CFP Financial Advisor and Principal of Transitions Wealth Advisors. And Jeff is with us, who is a fellow loan officer here at Bay Equity Home Loans. Jeff and Shawn have been working together for some time. Obviously know the value of partnerships, relationships, etc. But maybe we can kind of finish up, Jeff, and we could talk through with Shawn kind of the philosophy and the temperament of the market and why, historically speaking, it's still a good way to go.
Yeah, I think it's a good timing, especially with the way that the market has been over the last month or so here. But Shawn, what's your opinion on the historical perspective of how the market has been, and kind of looking at the market today and not doing that knee-jerk reaction of like, oh, I got to sell everything right now and get my money out, and how do you handle that stuff?
Well, fortunately, in my experience, I've lived through the last two cycles of the up and down market, and it's important always just to keep that perspective. If you look at March of 2009, right, we all remember how challenging of a time that was. Bank of America stock was trading at $2 a share. Right now, even with the downturn, it's at 11. We had you had what was called break the buck, where a money market fund actually lost value for the first time in the history. You had all these concerns going on, and at that point, if you had invested money into just a basket of the S&P 500 stocks, which was trading in the 700 range, and you look at what that would be worth today, it's probably worth 3-4 times that. But it's tough. It's tough to look at it. I mean, a lot of times when you're using historical numbers, you hear long-term averages, 50-year averages, 8, 9, 10%, depending on which segment of the market that you're looking at. And I think it's important, too, to reset your expectations based upon the time frame that you're looking at as far as the investments go.
Sure.
Ideally, we'd love to get those 8, 9, 10% rates of return, but you got to look at what's going on in the market right now. We're in a relatively flat interest rate environment where you can barely get 1% at the bank, right?
True.
This isn't the 70s and 80s where you could get double-digit returns on a money market or CD.
Do you have you done a pretty good job coaching your clients along the way, as far as, or you still get panic calls from time to time?
I'd like to say, without you actually calling, I'd like to say I've done a good job. I would say within the last month we've only had, I believe, one. And it wasn't a panic call. It was more concern. I definitely felt that a little bit more during the 09 downturn, and rightly so. I mean, it was a very, very difficult time.
Yeah, that's understandable. But before we go, I want to make sure, for those that might be interested in contacting you, give us a couple different ways how people out there could contact you, Shawn.
Sure. I think the best way, go to our website, and it's a rather long website, but it's www.transitions.wealthadvisors.com. And you'll find all of our contact information there on the website, and talks about our process and who we are and our team. There's 4 of us there in the office, myself and my brother, and as well as we have 2 other team members that it's our full-time service job to work with our clients.
Very good. Where's your office located?
We are in the heart of downtown Willow Glen in San Jose.
Nice. That's right. You said that early on.
Yeah, we love it there.
Yeah, Willow Glen's a great spot to be. Well, before we go, also, I want to remind everyone that take advantage of low interest rates. Jeff talked a little bit about earlier with Shawn, but recently here the last couple of days, the bonds have really rallied, and we have some outstanding interest rates out there. So if you're considering a purchase or a refinance, now would be a great time to consider that, absolutely, for sure. So I want to take this time, and Shawn, thanks a lot.
Thanks for having me.
Very informational.
Thanks, Shawn. That was great.
Yeah, Jeff, thanks for your participation as well. And one more time, Shawn, the phone number they could reach you at?
The phone number for our office is 408-357-7762. That's 408-357-7762.
And Jeff, if anybody wants to reach you?
408-340-7339.
Great. All right, we're going to have to duck out. Thanks again, Joe Cucchiara with Real Estate Radio Live, for joining us this afternoon. Take care. Have a great afternoon, and we'll be back with you tomorrow.